Why are real estate investment trusts so weak in the past week, in the past 2 weeks, and in the past 1 month? In fact, since the real estate investment trust hit a new high on the last day of last year, it has been 2 months and 1 day, and the REIT market in Singapore has just been all the way down. Yes, the color of today is red because real estate investment trust has been in the red for the last 2 months and 1 day. In this week's video, ladies and gentlemen, we delve into why and what caused this lackadaisical and terribly bad experience in the real estate market, as well as essentially what actually holds and what actually beholds of REITs, whether there is a recovery and when will the recovery come. This may not have come as a surprise to you, especially investors of GCP Global, because this is exactly what we shared in our past few investment classes. And for those who have been following our weekly videos, you notice that we've been warning about real estate investment trusts, in the last 2 months, and that's why it has been so weak. In fact, this week, we actually attribute it to a few things. One is that in the US, for example, if you look at the Magnificent Seven that's powered from the Amazon, Microsoft, as well as Google, you notice that in the Singapore REIT market, we have the reverse. Instead of having anything that's of magnificent value, we actually have a malignant value. In fact, we have a Malignant Six. Yes, ladies and gentlemen, this comprised of the dark REITs that we warned about in our video 2 months ago. That includes your US office REITs, the likes of Prime REIT, the likes of Manulife REIT, the likes of Capital, which has ceased and stopped dividend payment to you, the investors. Now, the likes of EC World REIT, Lipo Malls, and BHG REIT actually makes up the rest, as it's basically either they have stopped paying dividend or actually lower the payment. Now, in hindsight, this is a shocking thing, ladies and gentlemen. Then again, for those who have listened to our interview, with Channel News Asia, which was done just last month, as well as actually in our BT podcast with Business Times, in November last year, this is something they have warned about. We warned about the systemic risks that would actually come about if REITs actually cease dividend or DPU payment. In this case, you can see that the collateral damage is also being done and affected the good REITs, the likes of your Capitaland, the likes of essentially some of the better managed REITs. So within this Malignant Six, you'll be asking in today's video whether the problem that they have will continue to actually affect and abate all the other REITs, and to what extent will other REITs also stop paying dividend. Now, this will be shocking, ladies and gentlemen, if this continues to happen, simply because that the basis of investing in real estate investment trust is to get steady dividend, possible capital gain, and for those who are investing via Malaysia or Indonesia or Philippines, you notice that you have an element of forex pickup, against a strong Singapore dollar, and hence the preferred asset class that's Singapore REITs. But then again, this has been losing faith among investors in the last couple of months. This chart, ladies and gentlemen, shows you the global stock markets, including the US and European markets. You notice that from the US, that's the Dow, S&P 500, and the Nasdaq, to Europe, that's actually the STOXX 600 or STOXX 100, right to other Asian markets. You notice that it just has been firmly up. In fact, it's up almost 20% in the last 2 months alone in this year. Now, this other chart, ladies and gentlemen, shows you, our analysis and hence why we are so optimistic about the US equity despite making new highs, is the fact that this is predicated on 1 year performance, 2 years performance, and 5 years performance after the Dow and the S&P have made new highs previously, going back all the way to 1926. You'll notice that essentially making new highs is only the beginning of new highs, on US equities. But you look at our REITs market, you notice that this is a big problem. Okay, we are making new lows as equity markets around the world are making new highs. Hence, the red color, ladies and gentlemen, you can cry until the stream overflows. But then is the reality, because the chaos wrecked by the Malignant Six REITs, the ones that are causing virulent and a possible infectious uh, uh, problems on the other REITs is very real, ladies and gentlemen, as what I've highlighted in my various media interviews in Channel News Asia, Business Times, LIANHE ZAOBAO, as well as actually Business Times podcasts. You notice, ladies and gentlemen, that in the last 1 week, in fact, the last 2 months, you may ask, why is the REIT market has just gone downwards since we have warned on taking profit at the end of last year? It's because of this. Just look at this, right? Since the Federal Reserve actually indicated that the number of rate hikes this year will be trimmed down, to less than 4 now. The market expectations have been trimmed down from 6 to 3 as we speak. You notice that the 10-year bond yield since the beginning of the year, or rather since the beginning of February, has been in the range of between 4.15 to 4.35%. This is non-indicative of where rates will move, and that is creating a dilemma to the big problem among real estate investment trusts. Now, if you want to find out further, ladies and gentlemen, it's essentially where interest rates are moving. Do join us for our next class on 23rd of March, where we will delve into this deeper. We'll look and share with you which are the symptoms and which are the signs to look out for before we see the end to this treacherous market. But then again, for those of you who have been following us very closely, you notice that we warned in our Business Times interview, that this came from Wednesday, 17th of January, just 2 months ago, where we warned, and let me quote what Business Times quoted me. It says, veteran REIT investor and chairman of GCP Global, Gabriel Liap, also sees the return of lenders as a necessary step for US REITs. At that time, they were inquiring whether US office REITs have a chance of recovery. I told them that there's no chance unless a few things actually happen, and we don't even see this even happening until maybe closer towards 2030. Right now, I've mentioned that essentially that the year-end rally, so to speak, at that time, the likes of your U.S. office REITs actually gained a couple of cents, and I was quoted say that a couple of cents in recovery would not qualify as a rebound. For those who have listened to me, you notice that essentially you have avoided that. You notice that you will not be seeing this doldrums as you can see so far, because in the last 2 months, you can just look at the overseas REITs. Primarily has actually been crushed by another 50%. Manulife is crushed 68%. Keppel Oat is being crushed 66%. Lippo Malls is down 11%. And the other REIT that we've been warning about, that's Elite Commercial, has fallen even further by 12.5%. Now, if you just want to see and indicate essentially where is the next ghost hunting, that is actually swimming around, look no further than this particular list. And this is where we started our list, because we have caught up very, very rapidly with some of the CEOs of the foreign listed REITs. They are in this table. You can see, ladies and gentlemen, the next these and outperforming REITs is actually underperforming REITs is actually iREIT. You notice that we just had lunch with the CEO, Mr. Luis Overi, and Mr. Kelvin Tan. That's a gentleman on the right side of me in the photo. You notice that essentially it's one of the REIT that suffers one of the least drop in terms of valuations. So it may or may not, fall into this category of collateral damage, but it's something that we'll touch in depth in our class on 23rd of March. For those of you who are interested in that, please sign up then. Now, the next one that we actually follow up was just last month, where we actually caught up with Cromwell, which actually has European assets in Poland, Czechoslovakia, Holland, in Italy, and a few other European jurisdictions. You notice the gentleman there is the CEO, Mr. Simon Garing, and the lady on my wife's right side is Miss Elena Arabidjiba, who is the head of the IR. You notice that again, we have established and what we have actually come up with an opinion on the REIT. And if you want to know what is our opinion on this particular REIT, whether to be wary about or something that is presenting a bargain, do join us for our class on 23rd of March. I do confess that in the urgency of time, it's difficult to be able to analyze in depth on a YouTube video, because in our class we spend almost as long as 20 minutes to half an hour on a particular REIT idea. And guess what, ladies and gentlemen? Sometimes when we make it big, we do make it big in a big way. But then again, for those of you all who can't or unable to join us for our class, you notice that if you follow us in our newspaper clippings, you notice that we have been warning, and this came from the front page Business Times interview on the Monday, 22nd of this year. And what did we say? Let me quote what was quoted. Veteran REIT investor and chairman of GCP Global, Gabriel Liap, believes S-Reits earnings will be muted at best and disastrous at worst. Yes, and you can see that this slate of corporate results has been disastrous, to say the least, with foreign REITs facing the deadly combination that includes higher interest rates, foreign foreign exchange costs, gearing, and uncertain capitalization ratios. And indeed, I've warned about S-REITs with predominantly foreign assets in China, the UK, and the United States, and certain parts of Europe would likely underperform. So does it mean, ladies and gentlemen, that the likes of the other foreign REITs in their portfolio, the likes of ARA Hospitality Trust, Digital Core, Daiwa Logistics Trust, and Cecil REIT are to be avoided? Well, we'll discuss this in our class in detail on the 23rd of March. So, but then again, for example, let me just review some of the earning signs that we have already shown you. Just to be an example, as to share. So you notice that this is actually the chart of Elite Commercial REIT. Okay, now this is a REIT that we have told our GCP Global Investor students, who are comprised mainly of family offices, very high net worth individuals, and index fund REIT managers, to avoid from day one. Because if you look at the liquidity of Elite REIT since its IPO, for the first 1 year, they are just going sideways. Very little volume. You notice that essentially, it's the kind of REIT that don't want to be diversified into, because it is actually does not constitute diversification, it actually constitutes concentration in the first place. And if you have listened to us, came for our class, you notice you have avoided from day one the huge drop in Elite Commercial Trust. You can see the share price has collapsed from 70 cents down to 24.5 cents, ladies and gentlemen. That's sorry state. And in my previous video, which was just last month, I told you all not to throw in good money after bad money. That is actually throwing in money to subscribe for its preferential offer 27 cents. And then the share price now is 24.5 cents. Now, in today, Elite came out with something very interesting. Okay, the announcement just announced today, that's Monday, the 4th of March. They say that they have gotten a new 135 million debt for refinancing. Sounds like hooray, right? But ladies and gentlemen, look no further. Okay, look at number one. Okay, they tell you that this 135 is syndicated from a group of financial institutions, without telling us who are the financial institutions. Now, for those of you who dabble into real estate and are in the know in the European and the UK market, you will know that lending from private institutions, private financial institutions, be it hedge funds, private equity, are much higher than traditional financial institutions. But still qualify under financial institution as what's defined in the announcement, right? Okay. Secondly, does it mean that the current crop of financial institutions that are supporting Elite, is indicating or have given signals that they may not be so supportive going ahead, right? So this announcement raises more questions than any answers. But even that, let's say if it's a traditional financial institution, look further, okay? Elite already say and confess that their net gearing ratio stood at 47.5%. That means it's another 2.5% before they breached the 50% as at the end of last year. So what? If you have given 135 million, how much can you borrow to refinance without breaching 50%? Question number two, right? Question number three, ladies and gentlemen, is what is also indicated in the rate box I've enumerated. Now, EREIT proudly says that its credit is supported by the government-backed securities. As you can see, ladies and gentlemen, from or rather government-backed agencies, tendencies and agencies. Yes, from day one, Elite has promoted itself as catering to DWP, which is actually the arm of the British government supporting pensions. But you notice that, ladies and gentlemen, since day one up to now, the share price has fallen so much by almost 70%. The tendencies remain the same. Why is it that when Elite went for IPO, the NAV was 56 cents. As we speak right now, the NAV has dropped substantially by almost 30% to 40 cents. So if that statement, is that its credit is supported by its government-backed tendencies, then does it mean that these government-backed tendencies, are either 30% overvalued or not as well valued as what it was originally gotten at IPO level? Otherwise, it wouldn't have fallen that much, right? Well, again, this is just simple casual observation. It is not investment recommendation. Let me know your views, ladies and gentlemen. Because the problem we have in the real estate investment market these days is that it's not as transparent as what it should be, right? So other than my media interviews, I basically would try to communicate with you on a weekly basis some of these issues, and especially if this poses a systemic risk to the real estate investment market. So till next week, hopefully it will recover. But then again, hopefully this malignant six problem among these REITs, that is actually BSG, EC World REIT, Lipo Malls, and 3 US offices, will not spread. Okay, because it will take you time away from the magnificent seven that is actually riding and generating wealth, for your portfolio. And remember, ladies and gentlemen, the core in making your millions in real estate investment trust is to know which REITs to avoid and which REITs to position in a big way before they take off. Once again, happy week ahead, and do subscribe and like our video. And for those who want to join us for our class, we're actually extending our early bird special right up to the middle of this month. So do sign up at GCP Global website, where we will in our class forewarn you as usual our specialty and actually share with you which are the REITs to be well positioned when the rebound comes. We are definitely not as pessimistic as what the market suggests, but you definitely need to know which REITs to ride the market and which REITs to wash your hand and totally avoid, so that you will not be immersed in the rate as what the REITs market has been in the last 2 months and 1 day. Cheers.